The U.S. stock markets are currently closed. As of the closing bell on Thursday, October 16, 2025, Plug Power Inc., ticker symbol PLU, finished the session at $3.48 per share, a staggering drop of 37 cents, which translates to a 9.61% loss in a single day. Now, a decline of that magnitude immediately sends retail investors scrambling for headlines, often attributing it to broad market weakness or general sector anxiety. But the real story behind that nearly 10% haircut isn't found in the top-line news. The expectation is that this is just volatility in a high-beta green energy stock. The reality is that this move was likely catalyzed by a cascade of institutional order flows following a quiet but significant guidance revision from a key supplier in the hydrogen transport space, something that didn't make the front page but sent ripples through the desks of professional traders. This isn't just market noise, it's a specific signal that the underlying economics of building out the hydrogen infrastructure are facing headwinds far greater than management is letting on in their public presentations. It suggests the timeline for profitability, the very foundation of the bull thesis, might be stretching into an uncomfortable future. Most investors, especially those managing their own portfolios through platforms like Robinhood or SoFi Invest, hold a specific narrative about Plug Power. They see it as a primary beneficiary of the global shift towards clean energy. The company is supposed to be building the essential infrastructure for a future powered by green hydrogen. They have landmark deals with giants like Amazon and Walmart for their GenDrive fuel cells in forklifts. They are constructing massive-scale green hydrogen production plants in Georgia and New York designed to vertically integrate their business and capture value across the entire chain. The expectation, heavily fueled by the promise of lucrative government incentives like the 45V production tax credits from the Inflation Reduction Act, is that Plug is on the precipice of exponential growth. The belief is that you are buying a ticket to the future, much like early investors in Tesla stock felt they were buying into the EV transformation. It's an easy story to sell and an even easier one to buy into. The problem is that this story is starting to diverge sharply from the financial reality printed in their quarterly filings. Let's challenge that common ground. The reality is that Plug Power is a company in a desperate race against time, and its biggest competitor isn't another company, it's its own cash burn rate. That 9.61% drop isn't an anomaly, it's an amplification of a growing fear. The government tax credits, which were supposed to be a massive tailwind, have become bogged down in regulatory complexity. The Treasury's stringent requirements for proving additionality, that the renewable energy used to create the hydrogen is truly new and not just diverted from the existing grid, has made monetizing these credits a slow and arduous process. While investors were pricing in immediate benefits, the company is still navigating a labyrinth of red tape. Meanwhile, the cost of building these massive plants is immense, and in a high interest rate environment, the cost of capital is punishing. The company has repeatedly returned to the market to raise funds, either through secondary stock offerings that dilute existing shareholders or through debt instruments like convertible notes. These aren't the actions of a company comfortably funding growth from operations. These are the actions of a company that needs external capital simply to keep the lights on and the construction crews working. The story isn't one of inevitable triumph, it's one of financial survival. This is the kind of critical distinction that sophisticated tools on platforms like Interactive Brokers or the wealth management services at Fidelity are designed to help investors understand before they make a significant allocation. Looking closer at the recent trading activity, the volume on yesterday's sharp decline was significantly higher than the daily average. This indicates that the selling was not just passive, it was conviction selling. Large blocks of shares were moving, suggesting institutional funds were trimming or outright exiting their positions. This isn't your average retail investor panic selling on their Robinhood app. This is calculated, methodical de-risking by managers who see the mounting operational hurdles. When you compare this volatility to the relative stability of a mega-cap name like Apple stock or the momentum-driven strength of NVIDIA stock, the risk profile of Plug Power comes into stark focus. It operates in a different universe of uncertainty. The last earnings call was a perfect example of this expectation versus reality gap. Management spoke eloquently about their technological leadership and the scale of their projects. But the numbers told a different story. Gross margins remained deeply negative, and the timeline for achieving positive cash flow was pushed out yet again. The market is losing patience. It wants to see a clear, believable path to profitability, not just another artist's rendering of a futuristic hydrogen plant. The macroeconomic environment is a brutal headwind. Higher energy costs, particularly for the electricity needed to run the electrolyzers, directly compress already non-existent margins. Supply chain disruptions for key components are still a factor, causing delays and cost overruns. For a company that needs everything to go right, it feels like many things are starting to go wrong simultaneously. For those unfamiliar with the core business, Plug Power operates in a few key segments. Its foundational business is material handling, where it provides hydrogen fuel cell engines, GenDrive units, for forklift fleets in large distribution centers. This has been its bread and butter, securing its well-known customer base. But the grander vision, and the one that has attracted so much investment, is its plan to become a vertically integrated green hydrogen supplier. This involves manufacturing electrolyzers, the machines that split water into hydrogen and oxygen using electricity. They are also building the plants to house these electrolyzers and produce the liquid green hydrogen itself. Finally, they are also involved in the storage and transportation of this fuel to end users. The business model is to create a closed-loop ecosystem. They want to not only sell the fuel cell-powered vehicles, but also be the exclusive, long-term supplier of the green hydrogen that powers them, creating a recurring revenue stream. It's an ambitious model, and if successful, it would be incredibly powerful. But the execution risk is astronomical, and the capital required is immense. It requires a level of operational excellence and financial discipline that the company has yet to consistently demonstrate. This is where active online investing requires more than just buying the story. It requires constant scrutiny of the balance sheet. Looking ahead, the future of Plug Power can be framed in two dramatically different scenarios. The bullish expectation is that the company is currently navigating the most difficult part of its scale-up. In this view, the massive capital expenditures of today are building the revenue-generating assets of tomorrow. If their Georgia and New York hydrogen plants come online successfully, meet production targets, and, this is the critical part, fully qualify for the most lucrative tier of the 45V tax credits, the entire financial picture could change almost overnight. The company could flip from a cash-burning entity to a cash-generating one with high-margin recurring hydrogen fuel sales. In this scenario, the stock price, currently languishing below $4, would be seen in hindsight as an incredible buying opportunity. This is the outcome that many holding the stock in their Fidelity brokerage or SoFi accounts are hoping for. They see the current pain as a necessary investment for a future 10-bagger. Now, let's inject a dose of reality. The bearish scenario is that the operational and financial pressures become insurmountable. The cash burn continues unabated, forcing another and then another highly diluted equity raise at depressed prices, crushing the value for long-term holders. The new plants could be plagued by technical setbacks and ramp-up delays, a common issue in complex industrial projects. Competitors, perhaps larger industrial gas companies with much deeper pockets and existing infrastructure, could move into the green hydrogen space more efficiently. In this scenario, the government credits are not a savior, but merely a lifeline that prolongs the struggle without ever leading to genuine sustainable profitability. The biggest risk isn't that the hydrogen economy doesn't happen, it's that Plug Power, despite being an early mover, fails to capture a profitable share of it. The path of many pioneering companies is littered with arrows in their backs, and Plug is carrying a heavy quiver. Investors using more passive strategies like Schwab Intelligent Portfolios are likely shielded from this single-stock risk, but for those engaged in self-investing, understanding this bear case is not just prudent, it's essential for survival. Here's a question for everyone watching. Comment below what you think Plug Power's biggest hurdle is right now: cash burn or government red tape? I'm genuinely curious to see the consensus on where the